Something extremely unusual is unfolding across global markets right now, and most people watching the headlines still haven't realized how serious the situation has become. A military conflict in the Middle East is intensifying rapidly. Financial markets are sending mixed signals, and one of the most important indicators for precious metals is quietly flashing a warning sign that could determine where silver goes next. The conflict involving Iran has now entered its fifth stage of escalation, and the implications stretch far beyond the battlefield. A recent strike by Israel reportedly targeted a building where senior clerics had gathered to discuss the selection of a new supreme leader. That is not a routine military action. That is a direct strike at the political continuity of a powerful regional government. When leadership structures become targets, the uncertainty multiplies dramatically. At the same time, President Trump publicly warned that the situation could ultimately trigger leadership changes inside Iran. That statement alone adds another layer of unpredictability to an already fragile geopolitical environment. Markets thrive on clarity, and right now, clarity is in very short supply. Silver is currently trading around $84. Gold recently approached the $5,000 level and briefly tested support before bouncing. These numbers might look stable on the surface, but underneath them, the market is wrestling with competing forces that could soon push prices sharply in one direction or the other. Before diving deeper into the financial implications, it's always interesting to understand where people following these developments are located around the world. Viewers come from every continent, and the perspective of someone watching from North America can be very different from someone following the same news in Europe or Asia. So wherever you are today, think about how global these financial discussions have become. Markets are no longer isolated national systems. Every conflict, every economic decision, and every monetary policy shift spreads across borders instantly. Now let's step away from the headlines and examine the data, because the data tells a more nuanced story than what appears on television news segments. Major financial media outlets often focus on dramatic moments, but long-term investors look for structural changes beneath those headlines. The current conflict involving the United States, Israel, and Iran has entered a sustained operational phase rather than a brief confrontation. When military operations continue over several stages instead of ending quickly, investors begin recalculating the potential economic impact. And that brings us to something extremely important that happened recently. The president of the Federal Reserve Bank of Minneapolis, Neel Kashkari, acknowledged that the ongoing Iran conflict has introduced new uncertainty into the outlook for the United States economy and future interest rate decisions. That is a remarkable statement coming directly from a Federal Reserve official. Central banks rarely highlight geopolitical events as key variables affecting monetary policy. Yet that is exactly what has happened here. When a Federal Reserve president openly admits that geopolitical tensions are complicating economic forecasts, it signals that policymakers themselves are navigating uncertain territory. If the central bank cannot confidently map the path ahead, investors should assume the same uncertainty exists within financial markets. Interest rate expectations, inflation projections, and economic growth forecasts all become harder to predict during periods of geopolitical instability. Despite this tension, the price action in precious metals has been surprisingly restrained. Silver moved only slightly higher by roughly a fraction of a percent. Gold reached resistance near $5,400 but failed to maintain upward momentum. Silver even briefly dipped below the $80 level before recovering. In a traditional crisis environment, safe haven assets often surge rapidly. That explosive response has not fully appeared yet, and the reason lies in another part of the financial system that is attracting attention from investors. Government bonds are beginning to compete with precious metals as a destination for defensive capital. The yield on 10-year United States Treasury bonds recently dropped below 4%. While that might sound like a small change, in financial markets it represents a meaningful shift in investor behavior. When bond yields fall, the price of those bonds rises, making them attractive to investors seeking stability. This dynamic introduces competition for assets like gold and silver. Capital that might normally move directly into precious metals during uncertain times may instead flow into government debt markets. A prominent market strategist recently described this shift as a possible turning point, suggesting that speculators and bond traders might increasingly treat bonds as their preferred safety net rather than relying solely on gold. If that perspective proves accurate, it represents a structural change in how global investors respond to uncertainty. For decades, precious metals have served as the traditional refuge during economic turmoil. A gradual migration of safe haven demand toward bonds could reshape the way capital flows during future crises. However, there is an important condition attached to that theory. If the conflict expands into a larger and longer-lasting regional war, the entire calculation changes. Energy prices would likely surge, inflation concerns would intensify, and the demand for hard assets such as gold and silver could increase dramatically. In that scenario, the temporary advantage currently enjoyed by bonds could disappear almost overnight. Now let's shift away from the geopolitical backdrop for a moment and look at the supply dynamics in the silver market, because this is where the story becomes even more compelling. Beneath the daily price fluctuations and the constant noise of financial media headlines, the physical silver market has been undergoing a slow but dramatic transformation. One of the clearest indicators of this transformation can be found in the inventory levels at the Shanghai Futures Exchange. Current data shows that silver inventories there have dropped to roughly 350 tons. To understand why that matters, we need to look at where those numbers stood only a few years ago. Back in 2021, Shanghai silver inventories were sitting above 3,000 tons. That means over 80% of the metal that once existed in those exchange warehouses has now been drawn down. Think about that scale for a moment. A decline of that magnitude does not happen without significant structural demand pulling material out of the system. The question naturally becomes where all of that silver went, and the answer lies in several major sectors of the global economy. A substantial portion of that metal has been absorbed by industrial demand. Silver plays a critical role in modern technology, and the rapid expansion of renewable energy infrastructure has accelerated its consumption. Solar panels require silver for conductivity, and as solar deployment grows worldwide, the demand for silver rises alongside it. Electronics manufacturing also continues to consume significant quantities of silver because of its unique electrical properties. From smartphones and laptops to advanced computing hardware, silver remains a key component. Beyond industrial use, there is another force quietly removing metal from circulation: physical investment demand. Around the world, many investors have grown skeptical of purely paper-based financial assets. Instead of relying entirely on financial contracts that represent metal, they prefer holding the physical asset itself. That shift in preference gradually drains available supply from exchange inventories. Once silver leaves those vaults and moves into private hands, it often stays there for extended periods. While Shanghai inventories have experienced dramatic declines, another major hub for precious metal storage is London. According to recent data, silver holdings in London vaults stood at approximately 27,729 tons at the end of January. That figure was slightly lower than the previous month. Although the decrease might appear small compared to the massive drawdowns seen in Shanghai, it still contributes to the broader trend of tightening supply across multiple storage centers. When you combine these developments, falling inventories in Asia, modest declines in European vaults, and steadily rising demand from both industrial users and private investors, you begin to see the outlines of what analysts often call a slow-moving supply squeeze. It is not the type of shortage that immediately produces dramatic price spikes overnight. Instead, it quietly builds pressure over time as available inventories continue shrinking while consumption remains strong. Eventually, the paper price of silver has to confront the physical reality of supply and demand. Markets can remain disconnected from fundamentals for periods of time, but those disconnections rarely last forever. When inventories reach critically low levels, even small increases in demand can trigger outsized reactions in price. Before continuing deeper into the market analysis, it is worth addressing something important about how financial information is shared online. There are many channels and platforms discussing markets, and not all of them operate the same way. Some sell expensive courses, subscription memberships, or paid trading signals. Others promote specific investment products or attempt to guide viewers towards certain financial decisions. In contrast, the purpose of discussions like this is simply to explore market developments and explain the forces shaping them. Financial education becomes more valuable when it remains accessible and transparent. Understanding the global economy should not be limited to those willing to pay for information. When individuals learn how to interpret data, evaluate risk, and think critically about financial systems, they gain the ability to make their own informed decisions rather than relying entirely on outside voices. With that said, let's move into the technical picture for silver, because the charts themselves are revealing several key signals. At the moment, silver is trading just above the $84 level. Over the past several sessions, the metal has repeatedly attempted to move higher, but each upward push has struggled to attract strong follow-through buying. Every rally has encountered selling pressure that slows or reverses the advance. One notable development occurred when silver previously attempted to hold the $86 region, but ultimately failed to maintain momentum there. The subsequent decline and the inability to reclaim the 100-hour simple moving average have created a short-term technical challenge for bullish traders. That moving average currently sits near $88 and is acting as a dynamic resistance zone. As long as silver remains below that $88 level, the short-term technical bias remains cautious. It does not necessarily mean the long-term bull trend is finished, but it does indicate that the market may need additional time to consolidate before attempting another upward move. Looking at technical indicators provides further context. The moving average convergence divergence indicator, often referred to as MACD, has been drifting back toward the neutral line after previously showing stronger momentum. When this indicator approaches the zero level, it typically signals a transition from bullish acceleration into a more balanced or uncertain phase. The Relative Strength Index, or RSI, is currently hovering slightly below the midpoint of 50. That reading suggests the market is not experiencing panic selling, but it also indicates that bullish momentum has weakened. Instead of an aggressive rally, the price action reflects a period of consolidation where buyers and sellers are gradually negotiating control. For traders and investors watching the market closely, certain price levels become especially important. The first area of resistance appears around $85. That level corresponds to recent intraday highs where previous rallies encountered difficulty continuing upward. Above that, a stronger resistance zone sits near $86.20. This area aligns with earlier peaks where upside momentum began fading. If silver manages to break convincingly above $86.20, the next target would likely be the $88 region, where the 100-hour moving average currently resides. However, many analysts expect significant selling interest to appear near that level because it represents a widely watched technical barrier. On the downside, the first support level appears around $83.50. This area has acted as a short-term defensive line for buyers. If that support fails, the next important level sits closer to $82. That zone corresponds with a recent reaction low and also aligns with the nearby trend line. Should silver fall below $82 on a sustained basis, the next bearish target would likely appear near $80.95. That region marks a trend line break area, and a decisive close beneath it could indicate that the medium-term upward trajectory is weakening. However, there is still an encouraging factor for those who believe in the longer-term bull case. The upward support trend line that began around the $64 level remains intact. From a broader perspective, the rise from $64 to the current range represents a significant rally. Pullbacks into the low 80s can therefore be interpreted as normal corrections within a larger upward cycle rather than the end of the trend. Market cycles rarely move in straight lines. Even the strongest bull markets experience periods of consolidation and retracement. These phases can feel uncomfortable, particularly for investors who entered positions near recent highs, but they often serve an important purpose. They allow the market to reset momentum, absorb profit-taking, and prepare for the next potential move. Understanding that dynamic is essential for anyone participating in volatile markets. Price fluctuations are not always signals of failure. Sometimes they are simply part of the natural rhythm of financial cycles. Now let's focus on one of the most important indicators in the precious metals market, something that many experienced traders watch very closely when evaluating silver's potential direction. That indicator is the gold to silver ratio. Over long periods of time, this ratio has proven to be an incredibly useful tool for understanding how capital is flowing between the two metals. When the ratio moves sharply in one direction, it often signals a major shift in investor behavior. Right now, the gold-silver ratio is sitting around 61. That level places the market in what many analysts consider neutral territory. It does not strongly favor gold, and it does not strongly favor silver either. Instead, it reflects a moment where the market is waiting for a clearer signal before committing to a decisive move. Historically, the ratio can act like a coiled spring during these neutral periods. Eventually, it resolves in one direction, and when that happens, the resulting move in silver can be extremely powerful. There are two key thresholds that many investors pay attention to. If the ratio begins dropping below 55, it typically indicates that silver is outperforming gold in a significant way. During past bull markets in precious metals, this kind of breakdown in the ratio has often coincided with explosive advances in silver prices. When silver begins accelerating faster than gold, it usually reflects rising speculative interest and expanding demand across multiple sectors. On the other hand, if the ratio rises above 65, it tends to signal that gold is becoming the preferred safe haven asset. That type of move often occurs during periods of heightened fear or economic instability, when investors prioritize stability over growth potential. In those environments, gold frequently attracts stronger inflows, while silver lags behind. The current reading near 61 leaves the market waiting for confirmation. It is not sending a clear buy or sell signal yet. Instead, it is telling observers to remain patient and watch carefully for the next directional break. Many experienced traders prefer to wait for that signal rather than trying to anticipate it too early. This brings us to a question that many people have been asking lately. With geopolitical tensions rising, inventories shrinking, and industrial demand remaining strong, why hasn't silver already exploded higher? On the surface, the conditions appear favorable for a powerful rally. A conflict in the Middle East is unfolding, global supply is tightening, and long-term demand trends remain positive. Yet the price of silver has been struggling to push decisively above the mid-80s. The answer lies in several overlapping factors that are influencing market behavior at the same time. First, as discussed earlier, government bonds have recently become more competitive as a safe haven. When the yield on 10-year United States Treasury bonds falls below 4%, it changes the calculus for many investors seeking stability. Bonds begin offering a combination of income and perceived safety that attracts capital during uncertain periods. In practical terms, that means some of the money that might normally flow directly into precious metals during geopolitical stress is instead moving into fixed income markets. This does not eliminate demand for gold and silver, but it divides that demand between multiple asset classes. The second factor is the magnitude of the rally that already occurred earlier in the cycle. Gold climbed from levels below $2,000 to prices above $5,000. Silver experienced its own dramatic rise from the low 20s into triple-digit territory before pulling back. Those moves represent historic advances within a relatively short time frame. After such powerful rallies, markets often enter consolidation phases where prices stabilize and momentum cools. This process allows earlier gains to be absorbed while new investors evaluate whether current prices represent attractive entry points. Consolidation is not unusual after large advances. In fact, it is often a healthy part of longer-term trends. Another important variable is uncertainty surrounding the geopolitical situation itself. Financial markets dislike ambiguity. At the moment, investors are still trying to determine whether the current conflict will remain contained or expand into a broader regional confrontation. Until that question becomes clearer, many participants prefer to wait rather than committing aggressively in either direction. Economic data has also contributed to the mixed signals currently visible in markets. Recent reports indicated that private businesses added 63,000 jobs during the previous month. That number exceeded expectations and represented the strongest employment increase since mid-year. A resilient labor market suggests that economic conditions remain relatively stable despite geopolitical tensions. When employment remains strong, the urgency for the Federal Reserve to cut interest rates decreases. Higher interest rates or expectations of steady rates can create modest headwinds for precious metals because those assets do not generate income. Investors comparing yield-generating assets with non-yielding assets may temporarily favor the former. Taken together, these factors create a complex environment where bullish and bearish forces are interacting simultaneously. To navigate this environment effectively, it helps to consider both potential scenarios that could unfold in the coming weeks. The first scenario involves a de-escalation of tensions. In this situation, diplomatic channels successfully reduce the intensity of the conflict. Negotiations produce a ceasefire or at least a pause in hostilities. As geopolitical stress eases, the safe haven premium embedded in precious metals, prices gradually fades. Bond yields remain relatively low, continuing to attract defensive capital. Under those circumstances, silver could remain trapped in a consolidation range for an extended period. Resistance near $86 and $88 continues limiting rallies, while support near $82 becomes increasingly important. If that support fails, silver might test levels closer to $80 or slightly below before stabilizing again. The second scenario involves escalation rather than resolution. If the conflict expands and draws additional regional actors into the confrontation, the consequences could ripple through energy markets and global supply chains. Oil prices might surge dramatically, potentially exceeding $200 per barrel. Such a spike would likely intensify inflation concerns across multiple economies. In that environment, central banks could face a difficult dilemma. On one side, they would need to support economic stability. On the other side, they would be dealing with rising inflation pressures. Monetary policy could become more accommodative despite inflation risks, weakening the currency environment and increasing the appeal of hard assets. If those conditions develop, gold could break decisively above previous resistance levels and move towards $6,000. Silver would likely follow with even stronger percentage gains as the gold-silver ratio compresses. A move below 55 on that ratio could trigger renewed momentum that pushes silver toward the $100 mark again. The reality is that both scenarios remain possible. Anyone claiming absolute certainty about which outcome will occur is ignoring the complexity of the current global environment. Markets rarely move in straight, predictable lines, especially when geopolitical events play such a significant role. Instead of attempting to predict the future with perfect accuracy, experienced investors focus on monitoring key indicators that reveal how conditions are evolving. Several variables stand out as particularly important to watch in the near term. First is the trajectory of the geopolitical situation itself. Any sign of diplomatic progress toward reducing tensions could temporarily weigh on precious metals. Conversely, evidence of expanding military involvement or additional strikes would likely increase safe haven demand. Second is the direction of bond yields. If 10-year Treasury yields begin rising again above 4%, the competitive pressure from bonds may decrease, potentially allowing more capital to flow into precious metals. Third is the gold-silver ratio. As mentioned earlier, a decisive move below 55 would signal that silver is entering a stronger phase relative to gold. A rise above 65 would indicate the opposite. Fourth is the technical support zone near $82 for silver. Maintaining that level keeps the broader uptrend intact. Losing it could trigger deeper short-term corrections. Finally, the inventory levels on major exchanges such as Shanghai and London remain critical indicators of supply conditions. Continued drawdowns reinforce the supply squeeze narrative that many analysts believe will eventually push prices higher. For anyone following these markets, the key takeaway is discipline. Volatile environments reward preparation and punish impulsive decision-making. Investors who understand their strategy, manage risk carefully, and remain patient during consolidation phases often perform far better than those who chase every short-term move. Ultimately, the tension within the silver market comes down to one unresolved question. Physical supply is tightening, industrial demand continues growing, and inventories have fallen dramatically from previous highs. Yet paper prices have not fully reflected that reality. At some point, the imbalance between physical fundamentals and financial market dynamics must resolve. Either macroeconomic headwinds will keep prices contained for longer than expected, or the tightening supply situation will eventually force a repricing of the metal. Until that resolution appears, the most rational approach is to stay informed, monitor the indicators that matter, and remain flexible as new information develops. Financial markets are never static. They evolve constantly as economic forces, political developments, and investor psychology interact. Those who remain curious, analytical, and disciplined stand the best chance of navigating that complexity successfully. And as always, the most important principle remains simple. Approach every investment decision with logic rather than emotion. Protect capital, analyze the data carefully, and remember that uncertainty is not something to fear. It is simply the environment in which all financial markets operate.